back to Never Change. Here I intend to start a new series going through the basics of investing. So if you're a seasoned investor, this series will not be for you, but if you are new and starting out, then hopefully this can provide some helpful guidance. So I thought it best to start with a comparison. So why invest in the stock market over things like savings accounts or banks offer? So let's make a start. So in this example, I'll be this scenario, I have £1,000 to invest and I'm looking to invest it over a 2-year period. What would give me the best returns? I did a quick search on banks in the UK for savings accounts with a high rate of return, and so didn't spend too much looking, but this was what popped up first. So going through these, I chose the second one because it offers the second highest rate of return, but it's only going to lock it down for 2 years and you can open it with a £1,000 investment. So this is the example I will use for this scenario. So with this savings account, I will invest my £2,000. It'll be fixed for 2 years. So the first year is 1,000 divided by 100 times the interest rate, which will leave me with £1,007. Moving into the second year, again, I will have the 0.7% interest. So I will exit that year with £1,014.05. So after the 2 years, because that money's locked down for 2 years, I will walk away with £1,014.05. So my gains are £14 and 5p. It is pretty much risk-free. I mean, the only way you'd probably lose your money is not only if the bank would have to go under, but the government, the UK government would have to go under, because the UK government guarantees people's money at the moment up to about £85,000. So it's fairly risk-free, and if the worst was to happen, we've got bigger problems to worry about than you're losing your £1,014.05. So 99.9% risk-free. For the stock market example, I'm going to choose Microsoft, mainly because everybody knows Microsoft, and when you're starting out, you're not really going to know big companies, how well they're doing, but you can hazard a guess that Microsoft would be quite a safe bet. So Microsoft for this example, investing the same £1,000. So let's begin a little bit of analysis on this. So very, very roughly, so I didn't spend too much time, just on the charts, just quickly estimating what the rate of growth was for the past 5 years on Microsoft. So 2016, 18.38%, all the way up to 2020, 38.96%. So for this example, I'm going to take the worst performing year. I was going to use the average, which would have been 34.20%, but I decided no, we'll take the worst performing year in the last 5 years. Also, on some stocks, they sometimes pay out dividends. So with Microsoft, does pay out a dividend. So every year you get a yield of like about 0.9%. So if you invest £1,000 and it wasn't to grow a single percent and maintain flat, you would end up with £9 at the end of it. Now there is a tax associated with this, but because you're investing in an American company, your dividends are subject to American tax. Now the UK and America have an agreement where it's taxed at 15%, rather than, I think it's much higher normally if you didn't have this agreement, but they have an agreement. So that £9, you're looking at £1.35 in tax, so that leaves you with £7.65. Now this works slightly different because Microsoft do quarterly dividends, they don't do yearly, but for this example we're going to assume that they do yearly, just for ease of calculating what the likely return will be. I mean, it wouldn't really make that much difference anyway. So taking the worst performing year in the last 5 years, which was 18.3%, so we're going to look at what an estimated growth would be. So that £1,000 divided by 100 times 18.3 would leave you with £183 in gains. Add the £7.65 for dividends would leave you with £1,190.65 for the first year. Moving into the second year, again starting with £1,190.65, add the 18.3% gains again, and a slightly higher dividend of £9.10 would leave you with £1,417.64. So that would leave you with gains after the 2 years of £417.64, using the percentage growth of the worst year in the last 5. Now, with stocks, this isn't guaranteed. You know, there's nothing to say that they could lose 18%. But if you look at the trend of Microsoft over the past 10 years, they've always pretty much headed in one direction. So your capital is at risk, nothing is guaranteed, but your returns are much greater. So if we do a comparison, at the end of the 2 years for the savings account, £1,014.05. In the stock market, using Microsoft as an example, £1,412.89. So the analysis is, we're using the stock market as investment rather than the savings account. Your gains were 2,938% better using the stock market than a savings account. And to just put this into some perspective, for the savings account to equal just the first year of gains in the stock market, using Microsoft as the example, and the worst performing year in the last 5 years, it would take 26, almost 27 years for the savings account to meet the same gains as the first year of the stock market. I mean, that's phenomenal returns. Let's take this analysis one step further. So say you have a child and you want to put money away for that child. Now, would your return of investment be better in a savings account or in the stock market over, say, a 20-year period? So using the savings account that we found with a 0.7% interest rate, your £1,000 in 20 years would be worth £1,149. In essence, you actually lose money because that's less than inflation. Now, there are higher rates of return on savings account that you can lock down for, say, 3 or 5 years, but it's still nowhere near the type of returns that you can get from the stock market. So moving on to the stock market. So you're £1,000 invested in Microsoft using the worst year in the last 5 years in regards to growth, and also what they're currently the current dividend yield, which is 0.9%. Now there's a huge margin for error in here because there could be a catastrophe one year in which they drop 20%, or the dividend yield could go up or down based on the company profits. But if they just matched the worst year in the last 5 years going forward over the next 20 years, your £1,000 would then be worth £32,785. Huge margin for error. So even if we were 50% out, you're still walking away with like 16,500. That has got to be a far better return on your money than a savings account. So that brings me to the end of this video for the first in these series. What I intend to do moving forward is help a bit more in regards to, so how do I pick stocks? I mean, you can throw money at, you know, large stocks like Amazon, Microsoft, companies like that, but what about companies that are big but less well known and not that much in the public eye? So in order to pick a good stock to invest in, you need to know how healthy that company is. So there are a few analyses that I do in order to gauge a company's health and trend. So I do a Moat analysis, and so that's looking at growth rates across like revenue, sales, earnings per share, cash flow per share, book value per share. Also look at how the company is being managed. So return on invested capital, return on equity, and also look at how the company's debt is being managed and how is it trending. So debt analysis, and also, and most importantly, business valuation. So based on all the parameters that you've calculated, what is the sticker value for that company and what is it currently trading at on the stock market? And then using that, gauge a margin of safety. So a margin of safety should dictate when you enter a stock. And I generally use two margins of safety at 25% and 50%. So 25% lower than what the business valuation is would give, you know, it's an indication of you should definitely consider moving into this stock, unless the stock has dropped considerably in value for a certain reason. And also at 50%, and 50% is almost like get in now if you know that there is a healthy company there and they've just, you know, something's gone wrong for a short period of time. And a good example for this is actually Boeing. Now Boeing's stock price absolutely crashed through the floor in February 2020. Now, you know, Boeing is a monopoly. You know, there's only pretty much Boeing in the US that builds planes. Its only competitor really is Airbus in the EU. So you know that over time that share price is going to go back up to where it was, and if not further. So that's what investors would call a share price, a company going on sale. Another thing I intend to look at and show what I do is, so say if you've found 4 good, healthy, well-run companies, you've got £1,000 to invest, and you only want to invest in 1 or 2 of them. You don't want to invest in all 4. So that's where I use common size analysis in order to score a company and figure out of those 4 which ones would most likely give me the best return on investment. So I intend to show you how I do common size analysis. And that's it for this series. So thank you very much, and see you soon. Bye bye.